thanks everyone for joining us late in the afternoon. What a difficult panel to actually follow, because they've been really touching on a lot of topics. For us specifically, we'll focus on the funding and the equity gap. And the way this works, we'll give everybody the chance to really introduce themselves briefly and provide their view, 2 minutes, 2.5 minutes max. And then we'll go into the panel discussion. And I hope we have the slides up. There we go.
Well, that was me. Hi, I'm Andrew Gordon. I look after Invesco's European real estate debt business. Very, very brief slide. I thought I'd try and inject a little bit of optimism in the proceedings and talk about all the opportunities that are coming up from the so-called funding gap. We've seen a lot of activity. We've made a lot of different loans over the last 6, 12, 18 months. It includes junior loans where there's gaps in the capital structure, higher leverage where traditional lenders can't manage to get where they used to, certain jurisdictions where banks and other lenders are pulling back more quickly than they are in others, asset classes which are being left out of favor, again as a result of banks pulling back or being overexposed, and even certain sponsors who typically would have a lot of banks queuing up to lend to them are finding that those banks are overexposed to particular sponsors. So the impact of the debt funding gap, the impact that's having on traditional lenders is throwing up a lot of opportunities. What has become clear to us is that in order to take advantage of those opportunities, you need flexible capital and you need experience, expertise to actually build loans that work around the particular issues in any capital structure.
Jeff Thompson with GID, formerly with GE Capital for 20 years, one of the more prolific alternative lenders beginning in the mid-90s. So what you have here at the above, we're talking about financing or equity gap. It's really both. The top two charts really display what Jeff and Raf had been talking about and how did we get here in private credit. So the graph on the top left, that's the black line there are the large money-centered banks, greater than 250 billion, designated as SIFIs by Basel. And their percentage of their assets that are commercial real estate debt. So you'd see in 2007, 2008, they were bumping up around 8% of their assets, and they've now leveled off at 6%. But also referencing Jeff and Raf, it's a different form of lending that they're doing, much more in the warehouse line space where they get better.